Good morning, and welcome to today's webcast, Fuel Tax Exemptions, Credits, and Savings. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenter from Moss Adams, Dustin Hubbard.
Thank you, Chad, and thank you guys for joining us this afternoon or this morning, depending on where you're at. I look forward to the next 30 minutes and talking to you guys about fuel excise taxes. I am a managing director out of Denver in the state and local tax practice. I've spent about 20 years in state and local taxes, consulting, compliance, income, sales tax, excise taxes, and have just kind of done a wide array of different tax types and consulting projects with clients. So with that, we'll go ahead, we'll jump here into our agenda. And the first thing we're going to talk through is a little bit of a background and understanding of what the U.S. fuel excise tax is and its purpose. We'll then walk through federal excise tax exemptions for agricultural and off-road uses specifically, because those are the ones that I see the most often as I'm consulting with clients. We'll step into the state tax area and talk about their exemptions as well. And then if we have time at the end, we'll walk through some Q&A. Put a couple polling questions in here for you guys just so that I could get a little background on your experience with this area of tax and to better understand who's attending here. So if you can go ahead and answer, are you currently claiming fuel tax credits? And if so, how you're claiming those credits? No, you're not. Yes, you're picking them up as a credit on your income tax return, or yes, you are, and you're claiming them on quarterly returns. And while you're answering that question, I want to highlight the Q&A box. If you have other questions for me, it's just me today, so I won't be able to answer those as we go through the presentation. But at the end, if we have some time, I will answer those questions for you. And if not, then I will follow up with you after via email to answer those questions. So we got about 60% people responding. Give it another minute or another couple seconds here for you guys to answer that question. We've got about 70%. So then moving on to the next question, so it looks like about 65% of those that answered are not currently claiming, and then a quarter of you are claiming on your income tax returns, and then a quarter of you are claiming them on quarterly returns. So that's good information for me to understand. And then the last polling question that I wanted to throw in here is, are you currently generating alternative fuel credits? Those are things for like the use of propane in forklifts or natural gas or compressed gas in your fleet vehicles. And that's simply a yes/no question. I guess I probably should have put I don't know. If you don't know, just go ahead and hit no, and that will be the assumption I'll make moving forward. and you can answer those. You can also answer them, I think, by just clicking on the green box, if you would like. And that's how it tracks who's answered and who hasn't. But again, we got about 75% of the people responding. And again, it looks like majority of those are not claiming any alternative fuel tax credits. So we'll talk through some of those items throughout this presentation. And some of them I have reserved for a follow-up presentation that I'll be giving probably later this year or early next year. But wanted to just get some background on you guys. So a little bit of history on this gas tax, a little bit of interesting learning that happens here, but going through and understanding where this came from. The first one was imposed by the state of Oregon back in 1919. If you think about where that was, or where the country was and what was happening with regards to cars in 1919, this was right after the Model T had been out for not quite a decade. And so a majority of people, or a lot more people, could afford a car and could start driving and using the roads. And so Oregon came in and they imposed a penny a gallon tax, which at the time sounds pretty stiff to me, but that was the first one that came in, and they used that money for construction of roads and infrastructure to support cars. By 1929, most of the states had imposed a tax of some kind on gases, and then the first federal gas tax came in 1932. And again, thinking about what was going on in 1932, we were coming out of the Great Depression. We had spent a bunch of money on infrastructure projects to get the country back up and running, and the federal government was needing money to cover those expenditures, and so they threw the federal gas tax in there. Interesting thing about this is most of the rates at the federal level, they're not, and most of the states, they're not indexed for inflation. And so we'll touch on what that's kind of leading to as we move forward and are getting here in today's world and what that looks like. But how does it work? It's in theory, it's supposed to be a retail tax. So it's paid by the end consumer when they buy fuel at the pump, or they buy bulk fuel and have it delivered to their job site or their yards. That's when the tax should be paid. It should also, there's obviously from a refiner to a retail location, there's a bunch of different stops along the way where the tax could be imposed. Generally, I would say if you're documenting things, there's not going to be taxes imposed along that. Each step of that is going to be imposed on the final transaction, but you can find scenarios where it does get taxed in the stream on its way to the end customer. And so we can then look at, after that transaction, should there be credits or should you be taxed on it after that? And the answer is no. But that's ultimately where it should be happening. The rates that you find out there with regards to these taxes, from a federal perspective, it's pretty static. It's 18.4 cents a gallon on gas, 24.4 cents a gallon on diesel. And those have been the rates since 1993. So it's been 30 years, 40 years since we've updated the gas tax rate at the federal level, and you think about what's happened to the country in that time frame, and it's quite phenomenal that that's still the rates that we're using. The state rates, they range from 9 cents. This is just purely fuel excise tax, but they range from 9 cents in Alaska, which, you know, given the financial situation of the state of Alaska, that makes a lot of sense, to 59.6 cents a gallon in the state of California, which is the highest rate that you find out there. But they also hit every gamut in between there. And we'll talk about some of the other fees and taxes that get imposed on this at the state level. But what you run into then as you're going through that is this money is used to fund construction of infrastructure, right? So it goes into the Highway Trust Fund. That money then gets distributed out to build roads, bridges, to fund public transportation, buses, subways, that type of thing in major metropolitan areas. And then it's also used to repair all of these items. But what has happened since, at least at the federal level, since they've updated the rates, is we've seen the cost of the construction projects skyrocketing or increasing. Skyrocketing might be a bad term, but we've seen those costs outrunning the revenues that they've gotten. And part of that is the rates not adjusting for inflation, which they probably should. The other part of it is if you've seen mandates come out that say, hey, vehicle manufacturers, we need your fleet, every car that you manufacture, to have a higher fuel economy. So they need to be able to run farther on a gallon of gas than they have historically. And what that automatically does is says, well, if the rate is per gallon and we're buying less fuel, we're getting less gas taxes to cover higher cost infrastructure needs. And so there's a big change happening there. And then you have electric vehicles, right? Electric vehicles have come out. They've become extremely popular. You see them all over the place. And how much fuel tax are they paying? I mean, none is the answer. And yet they're driving on the roads. And the whole principle of these fuel excise taxes was the benefit principle of taxation, which simply states, if I'm using something that is built by the government, I should be paying for that. Those who drive on the roads should be paying for the roads. And so you have heavier vehicles in today's world than what we had back in even the 90s. You have more fuel efficient vehicles causing more road damage, less tax to come into the system. And then you have electric vehicles, which again are causing wear and tear on the roads, just like any other vehicle is going to cause, but they're not paying any taxes to pay for that infrastructure. And so those are kind of the strains that are on this system that are happening in today's world. And we're starting to see some change and some talk come out about that. Again, I'll reserve a lot of that for later in a later webcast, but that's kind of the state of where we're at today. So then talking a little bit about exemptions, and these, as I go through my practice and I work with clients, these are typically the things that I see happening, or exemptions that I see coming through where we can claim credits on. And the first one that we see is running power takeoff equipment. So I've got an over-the-road vehicle, a truck of some kind, typically, that is running additional equipment. And that equipment has a separate engine, but it may or may not have a separate fuel tank. And those are things like refrigeration units on trucks and trailers as they're moving food or other perishable items around the country. You have to keep those cool. Those refrigeration units a lot of times pull fuel off of the same tank as the trucks, the engine that's propelling it down the road. The other thing we see is trucks with vacuums on the back of them, or cement trucks or trash trucks, right? They're running that equipment sometimes while driving down the road, right? A cement truck is spinning as it's driving down the road. A vacuum truck, however, is not. It's parked at a job site. It's doing its thing at the job site, but it's running either off the current engine, off a separate engine, and it's more than likely sucking fuel off the same tank that is being used by the engine to propel the truck down the road. And then the other area that I've seen a lot of opportunity is in the fueling of other equipment. And you see this a lot in landscaping, the arborist, those professional service type organizations that are running around doing work outside and using other equipment besides a pickup or a truck to do that work. And that's lawnmowers, weed eaters, leaf blowers. In my experience, the crew is pulling up to a retail gas station. They're filling up the pickup that's got a trailer behind it that has all these things on it. And they're not stopping the pump. They're just taking the pump from that. They're fueling up all the equipment. They're filling up gas cans. So they've got enough fuel for the day. And then they run off and they do their jobs around the city. And they're paying tax on all of that equipment and all the fuel that is going into that equipment at the pump. You see it also wood chippers and stump grinders in those, I'll call them arborist type companies, where they're doing nothing but tree work around the city. And ultimately what this means, or what this is getting at, and these are some examples, is if I'm using the equipment off-road, I'm not using it to propel down the road, but I've bought retail retail gas and I've paid tax on that fuel, then I should have the opportunity to go and get a credit on the tax that I paid, because the tax is supposed to be tied to the benefit of using the road. And if the equipment's not being used on the road, then I have that opportunity. Another area where I see this is in the oil field services area. So you've got fracking companies, repair companies, they're going out to well sites, they're setting a truck there for a day, 2 days, 3 days, running off-road equipment to do whatever repairs or modifications to the well that they need to do. That's another opportunity where they're sitting there doing burning fuel, doing a job, and they've likely paid tax on that fuel. Some of those, they have separate tanks, but a lot of them, they don't. The issue you run into with all of these, and this is where I've helped clients work through this stuff, is the tracking. How do I know how much fuel did I use for off-road purposes versus propelling the vehicle down the road? And a couple of thoughts or ideas or things that we've looked at with clients. The first thing the IRS would tell you that you need to have some sort of tracking equipment on your trucks, a hub-o-meter so that it tracks mileage, an hour meter on your reefer unit or your cement unit, your trash compacting unit. You need some sort of tracking equipment so that you can get detailed information to understand how much fuel is being burned as you use that power takeoff equipment. The other thing that I've seen, especially in the bottom half of this slide, is purchase cards. So we have a purchase card that we give the crew when they go and fuel up. They run that purchase card, fill up the pickup. Then they run that purchase card again, or a separate purchase card, and they use that to fill up the lawnmowers, weed eaters, and that way it runs into the financial information automatically on this was purchased and put in the pickup, or the on-road equipment, this was purchased and put in the off-road equipment. But the tracking and being able to do that, if you don't have a system in place, then you end up in a study, again, where I've helped people, and you're taking a period of time and you're doing measurements of how much fuel is consumed by a push lawnmower, by a riding lawnmower, by a leaf blower in a day. How many days of the week is that thing running on average? And you end up with averages as opposed to accurate data. And you can get there and you can get people comfortable, governmental agencies comfortable with that. But this is an area that is on every state agency and the IRS's radar of something that they need to look at and make sure. It's been abused in the past, and so it is something that they look at quite regularly. So if you're claiming a big credit, the better the documentation around that credit you can get, the better off you're going to be as the states or the IRS reviews that. The other exemption, and this is, as a farm kid, this is near and dear to my heart, but is the agricultural exemption at the federal level. And this is for fueling farm equipment. And again, it smells and it reads, as you look through the guidance and the laws, a lot like off-road. There's a little bit of difference. There's certain things that qualify for the ag exemption that don't qualify for off-road. But if you look at the kind of equipment that is listed on this slide, you'll see that most of that is going to be off-road equipment: ATVs, compressors, generators, combines, tractors, drying, grain drying, nut drying type of equipment that all runs separate. Depending on how you buy that fuel, you can be paying tax on that. I know, in my family farm, we buy bulk gas, have it delivered to the farm, and that goes in pickups, trucks, ATVs, tractors, you name it, it all gets brought off of the same tank. And so tracking that information and applying for the credit is the easiest way to do that. The thing to keep in mind here, if you're going to claim the ag exemption, is it does have to be for raising, feeding, caring for some sort of horticultural or ag commodity. It can be animals, it can be chickens, it can be crops, it can be nuts, fruits, those types of things, but it does have to be some kind of ag or horticultural commodity. And the training of that and of animals can go in there. So you can have a horse farm where they're doing training, and a lot of the equipment that they're using that's burning fuel would qualify for an ag exemption. Moving on, we've got 10 minutes here to get through some of the state items. So looking at state fuel taxes, As we noted earlier, the rates differ by state. And as somebody who's spent 20 years in working primarily in state taxes, that's pretty standard. Also, the statute of limitations being variable by state. Some of these states you have 12 months, and so you have to get on some sort of a program where every month or every couple of months you are going back through your system and pulling the information together to file a credit or a refund claim with the state so you can get your fuel credits back. And again, in some of the states where the rate is 9 to 20 cents, depending on your fuel spend, it may not be worth running after. But I can tell you in those states where the rates are 30 to 50, 60 cents a gallon, it becomes very important and can be a big piece of money for you to go after those credits and claim those. The other thing that gets layered on at the state level are sales and use taxes, environmental fees, road usage fees, inspection fees. You'll just see a whole lot of additional fees that get layered on there, and you'll see some of those top rates start pushing 70, 80 cents a gallon. And then you start throwing in the federal rate at 18 to 25 cents a gallon, and you're paying $1 a gallon in taxes alone for every gallon of fuel that you purchase. And so that's where you can start to see this gets valuable to companies, especially in those professional service areas and some of the trucking and transportation areas, construction areas where they're burning a lot of fuel that could be exempt or is creditable, and that's where we come in and can help clients get through that. What you'll see then also from a state fuel tax exemptions is most of the states have very similar exemptions that apply in the off-road use and the ag use, but you have to be careful on a state-by-state basis and flip through those rules and make sure that you're hitting the right exemption. What you see, for like example, in the state of Ohio, what you would see there is Ohio doesn't have an agricultural use exemption, but a lot of your equipment and things would fall into an off-road use exemption, to where you could get money back if you paid that tax at the pump and be able to file claims on that. The other thing that you'll find at the state level is that some of these states run their fuel taxes through their sales tax system. And so it's a fuel tax, but the administration of it looks and smells like a sales tax. The exemptions of it are follow the sales tax rules. And so what you can find there is that there may be additional exemptions, like a manufacturing exemption, that would add on to your ability to claim additional credits at the state level. And so again, as somebody who's done this for a while, looking at each state's rules and looking at the rates that you're paying in each state when you look all in is an important step to run through as you go through an analysis of what is my fuel spend, what are the taxes that I'm paying on that fuel, and what are the opportunities sitting out there for me as I go through that analysis. So with that, we have 7 minutes left. So I will look through here quickly. Their first 5 questions. So there's companies. I didn't touch a whole lot on the alternative fuel credits, but I'll touch base on those a little bit because there were some questions or comments in the Q&A section about that. And so what I would say on that is when you're using, and I listed off 3: propane, compressed natural gas, liquefied natural gas. When you're using those types of fuel sources in forklifts, in trucks, fleets that are running around, there is an opportunity for a credit, and the credit can be 50 cents a gallon or in a gallon equivalent. So it does take a little bit of usage. If you've got 1 or 2 forklifts, there's a credit there. The question is, what's the value of that credit? And is it worth the time and effort to go after it? But there would be a credit there. If you're running 10, 12 forklifts, and those things are running 10, 12 hours a day, then you're starting to get to a number where that opportunity is sitting there to go after that credit and potentially get some money back for your company. Do forklifts and other plant equipment qualify? The answer to that is, I just kind of talked through that a little bit. I would say the answer is yes, depending on what they're running on. If you've got a diesel forklift, again, it depends on how you're buying that equipment, or buying that fuel that goes into that forklift. But yes, it's not running over a public road. That's where you would go after the credit on those types of equipment. Same with like yard trucks and things like that, that are specifically designed or kept inside the facility and running around the manufacturing facility. Then yes, those would qualify for that off-road exemption. Do forklifts ever create enough credits to make it worthwhile? I've seen it a few times, Brian, for sure. Can you claim a fuel exemption for moving ag goods between facilities? I think that depends on the facility's location and where they're at. I'd be curious to talk to you a little bit more about that. But yes, there is the ability, if you're moving it, especially if it's just down like within the same facility. If you're moving it over the road, then it becomes much harder to claim a credit on that. If you're using red dyed fuel, the purpose behind the red dyeing of the fuel is that you're buying it for an exempt purpose, and so there is no fuel taxes, at least at the federal level, imposed on that. And so depending on where you're located, there might be some tax credits out there from a state level, but in theory, from a federal level, there's no federal excise tax imposed on that red dyed fuel, and so there would be nothing left. And that's what you see some people do, right? Is if they've got bulk tanks on their job sites or in their yards, they will buy clear diesel, and that's what they will fill up their on-road equipment with. And they will buy dyed diesel, and they will fill up their off-road equipment with the dyed diesel. And that's how, instead of claiming a credit, they just get it up front because of how they purchase their fuel. And so there wouldn't be anything there where, at least from the federal standpoint, where you would be needing to claim a credit because you didn't pay the fuel tax at the onset when you purchased the fuel. Looking through here. I would have to look. There's a question in here about Native American tribes and exemptions for fuel sales to the tribe. Don't know the answer to that specifically, but having done enough work with tribes, that's going to be very fact dependent. So I would want to understand those facts to make sure that that's there. Where's the best place to find the rules for these state websites? A lot of these states, Oregon included, they have a fuel tax group that covers or handles these taxes and these refunds. It might be the sales tax group in your state, but in Oregon, there's a specific excise tax group that covers that, and they've got information on there. So with that, we've got 1 minute left, so I'm going to go ahead, rather than pulling another question, I'll pull down these questions and get through them and send you guys some emailed responses to your questions, or set up something so we can touch base on those. But I want to stop there and thank you guys for your time today. Appreciate you attending. My contact information is here. If you have further questions or you want to reach out to me and set something up to chat, by all means, send me an email and we'll get something on the calendar. With that, I'll send it back to Chad.
Thank you, Dustin, for a great presentation today. And as Dustin said, if we didn't have time to answer your questions, we'll do our best to follow up with you after the webcast. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this, as your feedback is very important to us. Thank you all for joining today, and hope you have a great day.